Hello and welcome to the State of the Lender Transition 2025. This is the third publication in our series of content pieces and interviews with people from around the industry, all with the aim of supporting mortgage lenders to better plan for the climate transition from this year onwards. As some of you know, we've recently released our study of 85 different mortgage lenders' climate transition plans. Our aim there is not to point fingers or suggest that some aren't doing as well as others. It's more to surface and socialize best practice such that the entire industry can move as quickly as possible towards a decarbonised economy by 2050, and so that we can identify those performing strongest in order to collectively learn from those efforts. On that basis, I'm delighted to be joined by Sophie Mason, Energy and Sustainability Lead at Coventry Building Society. Welcome, Sophie.
Thank you very much.
Before we get into the study, I'd love to get your thoughts on how you feel mortgage lenders are grappling with the transition to a low carbon economy. Do you have any opening remarks for us?
I think it's something that we're all still trying to navigate, and we need to be open and honest about that. Being mortgage lenders, it's a lot more difficult to move the dial on this versus other financial institutions that may do their majority of their financed emissions in corporate lending, for instance. We have a responsibility to educate our customers and make them aware of how they can decarbonise their homes, but we cannot enforce this. They have, their own choice of their own home, and they have the right to do that. And we also have the duty of care to provide that. Therefore, I think it will take time to collaborate across our sector on what we can do, look at innovation towards home efficiency technologies, what is the art of the possible. That then flows all the way through to government and then their priorities with grants, incentivising things. And then hopefully that would shift the change with public perception of this, and uptake would then become something that's easier to adapt with over time.
Absolutely. I think there's probably 2 points in support of that perspective. One is obviously the progress we've seen in lenders when they're grappling with Scope 1 and Scope 2 emissions, which they've been much more successful in reducing because they have far more control over them. The second of all is the wider sentiment that we need here is a whole of market approach. And trying to get mortgage lenders to support customers without brokers, for example, won't work because they both have various interactions with that end stakeholder. So a good start there. Let's get to some of the report themes here. Obviously, we've shared this with you before. One big theme that came out was this issue around inconsistency. So there's a sense that, there may be multiple different ways in which lenders can write a transition plan. Because of that plurality, we're seeing the divergence of response. Lenders are operating on a best efforts basis. Not all of them are aligning with the transition planning task force framework. In fact, we found only 5% are, even if many are adopting the principles, and 41% are yet to report at all. Is that a surprise to you?
I think it would be nice to see more financial institutions disclose against these. However, it's not really surprising because there is just so many guidances, standards and ways of looking at this, and the way to kind of cut the piece of the pie in terms of how you do this transition plan. So again, TPT is not mandatory for all yet. So again, some companies might be holding back. They might be actually doing this all internally, but choose not to disclose it externally. Again, that might be a factor because if the external reporting landscape kind of changes around us, as it has done phenomenally over the last kind of 2 to 3 years, they might set out their stall and say, right, we're here, this is our plan, but then external factors change that significantly, which would mean rebaselining, etc., and kind of shifting that dial again for them. And from an external perspective, and people that aren't within the detail of all these standards and frameworks, etc., it would just look like that they hadn't done it properly in the first place, and now they're kind of changing what they're committing to. So again, it's nice to be open and transparent, and it's nice to say we're declaring against this, but I also understand why some might be hesitant to do that for kind of the wider reputational aspects if again things do change and move.
Yeah, I think we've seen, for example, just within the the regulation, some flip-flopping over things like minimum energy efficiency standards, will they, won't they, 2025, 2028, 2030. That's been hanging over the industry for quite a while. And equally within the frameworks themselves, we're seeing TCFD is giving way to IFRS, which may lead to tougher regulations, for example. So plenty of evidence to support that statement. You mentioned about the frameworks. You think we're potentially muddying the water with too many acronym-led approaches. I'm thinking about TPT, SBTI, PCAF, TCFD, ISSB, as well as IFRS.
I mean, absolutely. It's kind of the running joke, and it has been. I mean, I've been in the sustainability industry for 15 years, and it's always been acronym soup, to anybody else that doesn't work in it. But again, more so with more frameworks, it's just becoming more and more. So again, it can be quite overwhelming to know what to adhere to, what you have to, or what's voluntary, and again, where the different guidances have overlays as well. So within those that we've just mentioned, and I won't go through them all again, all the acronyms, but some can be fairly similar and therefore easier to align to. But again, on the flip side, because they are very similar, it's quite difficult to know, and especially when it's in a voluntary capacity, which one you should kind of align to. So I suppose going forward, it would be nice to have that. Here is the overarching, this is what we should align to in terms of whether that's UK based or European, worldwide, etc. But as well, what we see being a mortgage lender and solely a mortgage lender within the financial industry, the kind of wider guidance that is provided through some of these frameworks doesn't really suit our business model. That one size fits all doesn't really sit well with us. Again, as my kind of opening point around mortgage lenders having it a bit more difficult in shifting that dial because of the constraints that we have. We're here to provide mortgages and allow people to have their homes. Therefore, embedding enforcements on efficiency of homes just isn't something, unfortunately, that we will or could or would want to do. Therefore, it might be more lending specific, on which framework we use and how to decarbonise that might be a better approach in future.
And within this then, what do you think the role of PCAF seems to be? So data scoring in some cases seems to be applied in different ways. So you'll see some lenders disclosing a PCAF score for the entire portfolio, potentially giving themselves a weaker score overall. Some lenders seem to be disclosing a stronger score, but potentially actually ignoring properties where they're missing data. Do you expect to see some sort of enforcements in approach or some kind of movements toward application of those standards?
I think it would be good if there could be clarity on what you should and shouldn't kind of disclose. And with PCAF, again, I know some might hold off from kind of looking at their whole book and disclosing their whole score. So again, if they've got a lot of estimates within their mortgage book, therefore they've had to estimate a lot of their EPC values to get that score. They might, only include this section where they have the actuals, etc. So again, having that clarity of you must disclose X amount, even if it is estimated on the majority of that. In my eyes, again, estimates of course are estimates and take industry norms, so therefore probably aren't the most accurate, but I think it's good to be transparent on this is the size of what we've got to tackle. Granted, we've got an element of estimation in there, but still it's that transparency element. It's that let's track how we can move the dial, and then track again how can we move to that more actual data rather than EPC's estimates or then estimating what an EPC is to then get your score as well. So yeah, again, clarity would be a lot nicer within that methodology.
That makes sense. I think when it was introduced to me, that the concept, the data quality score was described to me to prevent lenders from saying, well, or any organisation from saying, we can't disclose because we haven't got perfect information, when in actual fact, nobody does. So potentially disclosing more scores across more data points would support as well. On that point around data, we had this survey that went out to over 20 different mortgage lenders, and 80% described data quality as the number one area to improve in their transition plan. Is that something that you'd recognise internally? Have there been steps that Coventry BS have taken to improve?
Absolutely. Data is absolutely king. Without having, as accurate data as possible, your whole foundation, your whole strategy in which you build that from, it just falls apart. So, you need to try and have as much accurate data as possible. Obviously for Scope 3 in its entirety, not just financed emissions, that can be extremely difficult to get actual data. So therefore, you have to estimate using those industry norms. But again, that's still better than doing nothing and not tracking anything. So for us, we've been on a journey significantly since since about 2021. I suppose back at that point, it was, okay, what can we do to get all the actuals and accurate data to build our, scope 1 and 2 emissions and build the plan for that. So let's practice what we preach first and, sort our own emissions out. And then from about 2022 into 2023, we calculated all of our scope 3 emissions and looked at what that was, and again, what our total footprint was in its entirety. And then from then on, we've kind of looked at, okay, well, what are the highest elements of our scope 3? So for us, obviously, it's our mortgage book because of who we are and what we do. And the second one after that is our supply chain. So again, within both of those, they're all estimated. We estimate supply chain emissions on spend and obviously mortgage book emissions on EPC values. So again, we've been engaging heavily with our supply chain over the past year, 18 months, to get actual data on their emissions, focusing on our 80% of that footprint to get actuals, which has actually significantly brought down our emissions in that area. So whilst it's not a reduction as such, it is still moving in the right direction to get actual data, so you know where you are starting from and where you need to get to over a number of years. And same with the mortgage book. So again, that's a bit more tricky because again, we would like to have, actual data of what our customers are using every year. What is their total consumption of their home every year? Therefore, we can try and target which ones, are the high emitting, or where, some are more applicable for solar panels, air source heat pumps, etc., etc. And kind of, again, try and engage further with our members to move the dial. That's a little bit more tricky because it goes into the realms of data protection and GDPR. But again, we're looking at how we can get there and improve that with maybe through partners as well to gain that data, or directly from our customers as well, where they're willing to engage back with us.
Yeah, some great points. So I think what we found similarly is there's like multiple layers of benefits having more accurate data. One of them, as you've already mentioned, is that you do seem to get this dividend in terms of emissions, because the outdated data that's historically been used in some cases to calculate emissions is using outdated carbon intensity factors. It's assuming that we are as polluting as we were, 5, 10, 15 years ago. And therefore it is overclaiming and overstating the actual level of emissions. So improving the accuracy of your data, as well as giving a more accurate baseline to plan from, also in most cases brings you down rather than increases the number of emissions that you believe to be financing. So you could ironically argue that far from greenwashing, a lot of those lenders out there that are still using outdated data are in fact brownwashing their books because they're overstating.
Yeah, absolutely.
We saw in the data we collected that 59% had a plan, but only 3% could report material reductions in emissions. And we did define that as at least a 7.5% reduction in carbon emissions year on year, because that keeps you in line with the CCC's decarbonisation pathway for UK property. What do you think the big challenges are in delivering actual decarbonisation? Why the gap between planning and actual impact?
Well, I think it comes back to the challenge that is just scope 3 for all of us. It's indirect to our business operations. Therefore, we have to rely and influence others to help us reduce that as well and come on the journey with us, whether it's our suppliers or our customers or, anything else that makes up our highest part of our scope 3. So again, influencing those to come on board with us with our journey is kind of a key factor and something that can be quite difficult. Again, we need collaboration because we can't just do this on our own and get there, even if we do all the best work in the world internally. Or again, it could be we haven't got the accurate data as we've mentioned. So things actually, might be decarbonising better than we think. But again, we've got lots of estimates within that information in that portfolio. Therefore, it might be the data accuracy that's the issue because we're using, again, these industry norms and we might be better off than we think. So yes, it definitely comes down to influencing others and then ultimately trying to improve our data accuracy as well.
Okay, so let's move into the Coventry then. And one of the reasons we're excited about talking to you today, Sophie, is that Coventry is one of the strongest performing lenders across the host of metrics that we looked at the study. Could you talk us through your approach and how that has changed over time?
I think for us, we all started with implementing the basics. You've got to have a good foundation of data. and then also embedding governance within the organisation, engaging others to come on and help. So we obviously sit in a sustainability team, but we need buy-in from, from the top down, from the board, from the exec, to basically endorse and approve our strategy on what we want to do, and it authorises to spend the money that this takes to get there as well. But then also we need colleagues from risk, we need treasury, we need our procurement teams, etc., on board with us to help us again deliver our strategy and what we want to do. So it isn't something that can just be done in a year. It takes time, it takes planning, but I think again getting those basics and that foundation in place is something that we've done really, really well. So for us, we've had that phased approach. We've kind of kicked this off in 21, but then we've looked at our plan, reviewed it annually, looked at our internal factors, the external factors that impacted us as well, ensure that we can constantly evolve that plan as and when we need to, so we can ensure that we stay on track and deliver what we want to and what we need to in this space.
If I could invite you just to put aside modesty for a moment, so if you can just talk us through, what are you most proud of with Coventry Transition Plan at present?
I think for us, one of the big successes has been the engagement within the organisation and the buy-in into this. We really have managed to embed sustainability throughout the organisation and bring people on this journey. So as I mentioned, 2021, this kind of all really ramped up and started, and that's only 3-4 years ago. And we've seen some material change happen within our environmental impact as a business and with our emissions. So again, for me, I'm really, really proud of that and the team that we've managed to build around that to deliver the success. And that then echoes into some of the external recognition we've had over the last couple of years. So from yourselves as well, putting us 8th on the list, I believe. And then also we achieved B Corp status as well last year. So that was a big moment for us, again, to show our sustainability credentials. And then finally, earlier on this year as well, I've got to plug this, we won the Carbon Reduction Programme Award at the National Sustainability Awards as well. So yeah, it's something that we're extremely proud of, but a lot of hard work has gone into it to then deliver the recognition afterwards.
Yeah, I'm sure. And what was the Carbon Reduction Programme all about?
So it was open-ended. So basically, what have you done in terms of your carbon reduction? So what has been your plan, your strategy? How have you delivered that and embedded that? And what has basically been your success off the back of that was kind of the criteria. So the headline was 34% reduction in 3 years through targeted interventions. So yes.
So I suppose the next question really is having delivered some success already, what's next? What are the future priorities?
So our main priority is obviously our biggest part of our emissions, which comes from our mortgage book. And as we mentioned, trying to influence and engage people to come on board with you is absolutely a key driver. So it's that continued evolution of how do we engage with our members, how can we educate them, how can we move the dial on this and help deliver further reductions. But I suppose the other thing, and the elephant in the room for the Coventry Building Society at the moment, is that we have an imminent acquisition of Co-op Bank coming up. So that's due to complete in early 2025. So of course, naturally, over a space of time, obviously, we'll have to merge the businesses together. Therefore, we'll have to look at their impact, our impact, kind of re-strategize what is going to be our new baseline is collectively, together. That will naturally double, of course, in terms of our impact. So again, what is our new plan? What is our strategy to get to net zero collectively as well?
You talked about the need to engage with members as part of tackling the biggest part of your emissions footprint. We've kind of touched on this already, but we have seen low levels of retrofit lending. I think there's a strong argument that right now supply is outstripping demand in terms of the number of new propositions that have been launched versus the number of customers that are taking lenders up on the offer of, in some cases, very generous discounted rates to go ahead and make those home improvements. But we've also seen that we're in an energy crisis where millions of UK homes could be improved in a cost positive way, simply because the energy savings now are dramatically higher than they were just a few years ago. So do you see an enhanced role there for lenders to perhaps kind of join some of those dots and better educate your members on the retrofit potential of their homes?
Absolutely, yes. We absolutely have that responsibility as lenders to provide customers with information to make the right and informed decision for them and their home. Absolutely, we need to be able to help and assist them to do whatever they wish to do with their home to be more efficient, and also highlight products, or whether that's grants, or again provide them on information on what to tackle first. You know, most people don't have a clue where to start, so what is the best thing for their home and their setup, and what will give them the best return on investment, I suppose. However, within this though, the kind of again thing that's very difficult is some of the technology just doesn't provide the payback at the moment, so hence I think the lack of appetite within the public to kind of take this on. The prime example probably being an air source heat pump. Obviously we know we need them, we know we need to electrify our heating. However, in doing so, it's a lot of capital outlay, it's a lot of money to purchase and install it, and then ultimately running costs tend to be higher, or will be higher, just through the simple fact that electricity costs more than gas. So therefore, there isn't really that carrot yet to incentivise people with the technology available. Solar's a no-brainer, obviously, and things like insulation, etc. But the bigger pieces that will deliver that decarbonisation is difficult to sell, I think, at the moment. So again, we need to kind of step in, again, cross the sector and all come together to do that collaboration on what can these technology improvements be, or what can we innovate, or how can this be better, so then it's viable for the masses, and then once that's there, and it kind of makes sense from people getting a return on the money that they're investing within their homes, I will definitely see that shift within the wider public and our consumers.
If we return to the challenge of planning, as well as motivating customers, we looked in our study around drivers' behaviour, and the top two that came through was number one, adhering to reporting regulations and requirements, and then number two, assessing and managing climate risks. Are they kind of priorities which are reflected internally, and how do you respond to those sorts of requirements and risks?
So for us, I'm not sure they would be exactly our top two drivers. For us, because we're a building society and a mutual, we genuinely make decisions based on the right thing to do and what's in the best interest of our members and our colleagues. So our business model may be slightly different to, you know, a large corporate, for instance, with stakeholders. But of course, you know, things like reporting requirements and risks, naturally we take into consideration. With reporting requirements, anything that's mandatory, of course, we have to adhere to. We're trying to go above and beyond and do the voluntary requirements as well, to again show our willingness towards this and again doing the right thing. And then naturally the risks that we have as a business that come from climate, like any other risk, you know, you have to monitor them, you have to then put in steps to mitigate that risk to your business if, you know, the worst eventuality was to happen. So I don't personally believe they would be in our top two in terms of drivers, but absolutely they are up there because of the nature of what they are, I think, is just generally running a business.
So we've also seen more recently on the subject of climate risk and transition risk, the re-emergence of the minimum energy efficiency standards. I jumped the gun on this earlier in the interview. We sometimes talk about this kind of transition risk paradox, in that it's not fully defined yet. You know, the regulations haven't become law, but when they do, they'll come into play in a lot faster time frame than, say, flood risk, which typically are assessed up to 2050. How are you planning to tackle that challenge internally? Has it impacted how you're thinking about climate risk or transition risk overall, or how you might disclose some of that risk in your reports?
So yes, internally we are defining that and what that might look like within our book, and then again what we would need to do to ensure that we adhere to the kind of new regulation that's coming through. However, again, we're just kind of waiting for the final this is happening. Again, one, from a disclosure point of view, but then two, also from an engagement point of view with our buy-to-let customers. We don't want to be ill-advising them and kind of jumping the gun now if then the goalposts move and the dates move or the efficiency rating moves, etc. But we are, again, becoming prepared internally with our strategy on what we would need to do from a risk, engagement and disclosure perspective. We'd also look to focus on external partnerships, again, to raise awareness, what grants are available, etc., and do, again, that specific engagement with buy-to-let mortgage holders. It may well be that we have to set up monitoring of both stock and flow and consider any policy or product changes as well that we might have to do with this. But again, we're prepared, but we aren't going yet until government have kind of given it the final rubber stamp of when this is happening. But yes, all will come.
So we've talked about a range of different things, from current risk to future risk, relations, reporting, customer support, touched on quite a few different areas. So I suppose it's only fair really to say, let's imagine that Coventry hadn't started back in was it 2022 or before. If you're coming into things fresh, knowing what you know now, where would you begin? Or to rephrase the question, what advice would you have for others that are just starting out on their transition planning journey today?
I think it's start with the basics. Don't look at this in its entirety and think I need to solve it all now. It's start with the basics, get your data. As we said, data is king. Get that in a good order. Then lay out what is your foundation, where are we starting from, get the headline number, okay, this is what we've got to deal with. Also looking at embedding your governance, engaging the wider stakeholders as well. You can't do this alone. It absolutely takes that buy-in from the top level and then throughout the organisation to enable others within the organisation to come along the journey with you and help you deliver what you need to deliver. So I suppose it's that basics of foundation, governance, and then look at, okay, what could be our strategy, what are our options, what are our scenarios, and be quite realistic in that plan as well. And again, acknowledge that you can't do this in a year or two. It is something that takes a literal transition over a period of time. So again, kind of put in those short, medium, long-term goals that you want to achieve, and then keep reassessing them. Again, are we on track? If we're not, why aren't we? What can we do to bring it back on? Or if we're exceeding that massively, can we change the entire plan to become, more aggressive and more ambitious in what we want to do? So yes, the basics of data, engage with others, make a realistic plan, and then continue to track against that. How are we doing? And continue to evolve basically over the years.
That's absolutely fantastic, Sophie. Thank you very much.
You're welcome.